Tortoise Senior Portfolio Manager Rob Thummel joins us now. Rob, thanks for being here. Just want to get to you on the news. Do you think these efforts to boost prices will be successful here?
Yeah, I do, Leslie. I think if you look at what Saudi Arabia is trying to do, they're trying, and OPEC in general, they're trying to create an undersupplied oil market. And that's really what's going to happen in the second half of the year. You had an oversupplied oil market the first half of the year. That led to lower oil prices. Likely have an undersupplied oil market in the second half of the year with significant declines in inventory. And so ultimately, historically, that has meant when you see inventories decline, that means prices, oil prices typically rise. And so that'll be a catalyst for the energy sector really over the next 6 months.
The market doesn't seem to think so, though. Crude, we're showing a picture right now, down 0.5% today. What's the lag for something like this actually working its way through to the market?
Yeah, I think the market's trying to figure out, is the oil price signaling a looming recession? Basically, will demand not be there? So the supply part of the equation, I think, is pretty clear. You're going to see less supply. Also, you're also going to see less supply in the U.S., by the way. That's not a lot of people are paying attention to the lower rig count, but that's going to reduce the supply in the U.S. as well. But the demand, that's the question, right? And so what will happen there? It really looks like, the U.S. economy, the consumer seems to still be strong. Travel seems to be pretty robust. Chinese mobility seems to be returning. Industrial activity is likely to come back. So all of that really means more energy, probably more U.S. energy and more low-cost energy. So I think this just has to play out. The market has to see that demand calm, that undersupplied oil market really exists, inventories fall, and then there'll be a price response.
Rob, there's been this line out there that I think makes some sense, that the oil industry in general can make its peace with prices at current levels. I mean, what parts of the sector do you think are well positioned, even if we stay range bound in terms of the commodity prices?
Yeah, that's a good question, Mike. And so, Tortoise, we really like energy infrastructure at $70, $80, even $60 for this reason. It really, the energy infrastructure sector, in particular the subsector, performs well when oil prices are steady, when they're not volatile, because that's consumer demand remains pretty high. And frankly, lower oil prices typically boost consumer demand. And so that's good for energy infrastructure companies like pipelines, right? So these pipeline companies generate a lot of excess free cash flow. They're returning that free cash flow to the shareholders in the form of high dividends. You get 7, 8, 9% dividend yields from these companies. In addition, they have excess cash flow to buy back stock as well. So from an energy subsector perspective, we think that that's a great place to be. And if you look back, even at the first half of the year, energy infrastructure actually was up about 6 or 7% for the first half of the year, while almost every other sector in the or every other subsector in the energy sector generated negative returns for the first half of 2023.
Yeah, Rob, I see Cheniere is your top holding in your Tortoise Energy Infrastructure Fund. Why do you like it? And in 2H, do you add or sell to that position?
Yeah, so Cheniere, we've owned Cheniere for probably over a decade. It's an outstanding company. What Cheniere does is exports U.S. Liquefied natural gas to countries around the world. A lot of people know this name, but it continues to have really all of the elements that we like for any stock, frankly. It offers a critical service, so we all know how important liquefied natural gas or natural gas is, not only in the U.S., but globally as well. And that obviously has been made even clearer, really, in the last year with the Russian invasion. But Cheniere plays a really important role in supplying not only Asia, but also Europe with liquefied natural gas. But the financial side of Cheniere and how the management team has managed the company has been outstanding as well. They've reduced debt significantly, but they've also generated a lot of free cash flow. They've started to pay a little dividend, but they're holding on to a lot of free cash flow to buy back stock. And they think the stock is cheap, and so as a result, they're buying back their stock. And so we continue to like Cheniere, and you'll continue to see us add to that security for a long, long time, because the contract length for Cheniere's a couple decades, and it's going to generate steady free cash flow for a long time.